What is up, guys? Welcome back to the Capitalist Investor YouTube channel, back with another video. Today, the good, the bad, and the ugly for investing legend Warren Buffett, a 2020 review. Before we get into today's video, can I ask that if you are new to the channel, you hit the subscribe button. I'm on a journey to 200 subscribers, just 15 off that number at the time of recording this video, and would really like it if you can join me on this journey. Also, if you can smash that like button, that'd be very much appreciated. It helps me get this video out to more people and lets me know you love the content I'm delivering. So let's get into today's video. So I'm guessing most of you know who Warren Buffett is, but for the few that might not, Warren Buffett is an American investor who is considered one of the most successful investors in the world. He had a net worth of 89 billion as at December 2019, making him the fourth wealthiest person in the world. Buffett has been chairman and the largest shareholder of Berkshire Hathaway since 1970. So, what has been good for Warren Buffett of late? I think good things have not been well publicized, and people have focused all too much on the mistakes or bad things that Warren Buffett has done, particularly over the pandemic when the markets have been hit. But there are good things. For instance, despite the intense criticism, Buffett has done at least one thing right. Berkshire owned more than 5.5% of Apple at the end of March, making it the tech titan's second biggest shareholder. Apple's stock price hit a record high this week, boosting the company's valuations to almost 1.5 trillion, and the value of Warren Buffett's stake to north of 83 billion. Berkshire's Apple stake was worth about 72 billion at the end of December, meaning it has scored a gain of more than 11 billion on a single stock, which happens to make up more than 40% of the value of its stock portfolio. And this was just in a matter of months. In addition, Berkshire held about $993 million worth of Amazon stock at the end of December. The e-commerce titan's shares also climbed to a record high this week, lifting the value of Berkshire's stake to nearly $1.4 billion. Even after it cashed out 4,000 shares, or about 0.7% of the position in the first quarter. True, there might be some negatives for Warren Buffett, but its Apple and Amazon gains show the boss hasn't entirely lost his touch. Okay, well, what about the bad? Warren Buffett has lost at least $7 billion from his last three big investments. That's Kraft Heinz, Occidental Petroleum, and airline stocks. They have lost at least $7 billion altogether out of an investment of roughly $10 billion in each. In 2013, Berkshire and private equity firm 3G paid $23.2 billion to buy Heinz, and 2 years later Heinz bought Kraft Foods Group for $54 billion. Kraft Heinz Co. stock moved closely with the S&P for a couple of years. Then, after hitting an all-time closing high above $93 in February 2017, it began a long decline. Last year, Berkshire wrote down its investment by $3 billion, while Kraft Heinz took a $15 billion write-off on its Kraft and Oscar Mayer brands. In February, even before the market sell-off began, Fitch Ratings and S&P Global Ratings downgraded Kraft Heinz to junk status. Meanwhile, in 2018 and 2019, 3G sold millions of shares. It still has a big stake, as Berkshire held firm. As of March 31st, Berkshire's Kraft Heinz shares were worth about $8 billion, around $2 billion less than what it paid for them. Just 2 months later, in August, Berkshire completed a $10 billion investment in Occidental Petroleum, which helped Oxy win a bidding war against oil giant Chevron to buy Anadarko Petroleum for $38 billion. The deal made Occidental the biggest player in the US basin, the world's highest producing oil field. Berkshire's got 100,000 preferred shares, which gave it first dibs on dividend payments if things went south. That's exactly what happened 6 months later, after the recent collapse in crude. Occidental cut dividends on its common stock by 86%. But it still owes Berkshire a hefty 8% annual dividend on the preferred shares, which Occidental has to pay out in depreciated common stock rather than cash. Occidental common shares changed hands below $15, about one third the $44 a share at which it traded when the deal closed. As of March 31, Berkshire had lost around $500 million on the common stock it owned, but the April dividend payment doubled Berkshire's common shareholdings, cutting its paper loss in half. You can't determine a current price for the preferred shares for Occidental, which don't trade regularly. The accumulation of these preferred dividends over time, whether in cash or common stock, could soften the blow for an investment that at best looks like a masterpiece of bad timings. And then finally, there were the airlines. From mid 2016 through early 2017, Berkshire bought tens of millions of shares in the four largest US based carriers. That's American Airlines Group, Delta Airlines, Southwest Airlines, and United Airlines. The price tag was north of $9.3 billion. But when coronavirus hit, airline stocks plummeted, and by the time Berkshire dumped them all in April, they were worth about $4.3 billion. Assuming all shares were sold on the SEC filing dates, that amounts to a stratospheric loss of $5 billion. Adding all those losses together, and you have at least $7 billion hit to Berkshire, not including any decline in value on the Oxy preferred shares it owns. Buffett has had some bad luck. Who could have foreseen COVID-19? But the problems with Occidental happened soon after the deal closed, and there have been big clouds hanging over energy stocks for years. Buffett also waited until April to dump airline stocks, and this was right near the bottom of their value. All of these three examples, and I'm sure there's many others out there, suggest bad news for the legendary investor. So how about the ugly then? Well, Warren Buffett's Berkshire Hathaway lost billionaire Bill Ackman as an investor. Ackman revealed the sale of his Pershing Square Fund's $1 billion stake in Berkshire. Berkshire accounted for just over 15% of their $6.6 billion stock portfolio at the end of March. So why did they sell their share in Berkshire? Well, they sold their share to free up cash so it can capitalize if juicy investment opportunities emerge. This was cited as the main reason for withdrawing the investment. It was quoted as saying that not deploying the $137 billion in cash reserves to buy stocks and other securities, acquire companies, strike deals, and repurchase shares was one of the main reasons, which to many would suggest a lack of trust in Warren Buffett himself. Is this just the start of seeing companies and investors moving away from following Warren Buffett? I think only time will tell. My personal view is Mr. Buffett has had a tough time of recent, but he is a long-term investor and he knows what he's doing. And I think his next moves, when he decides to do them, with the cash pool that he has, only can spell interest in terms of being successful. That's about it for today's video. Not a particularly long one, but hopefully an interesting one nonetheless for you guys. Thanks so much for sticking with me. Please do subscribe to the channel, hit that like button, and let's grow this channel together. Until next time, guys, I've been the Capitalist Investor, and I'll see you on the next one. Peace!